So time value of money, problem 4. So bank balance, line of credit situation. A company has a line of credit with the bank. The interest charged by the bank is 1% per month. Money is paid into the account at any time of the month and withdrawn at the end of the month. Interest is charged based on the balance at the end of the previous month. Assuming there's no balance at the start, before January that is, and assume that the cash flows to the company are shown as below. So positive amounts indicate borrowing and negative amounts indicate payments into the account. What is the balance at the end of May? Well, this is a standard business situation. A company uses a line of credit and we want to track the bank charges and the account balances. So let's take a look at this. We basically need to calculate the balance at the end of each month. So how do we do that? We're going to calculate the interest that is due, and then we add any changes and movements in the account based on either borrowing or borrowing is withdrawals or payments back to the account. And the way we're going to calculate it here is that we'll take the beginning balance times 1 plus the rate per period, which is 1% a month, and then we'll increase or decrease that answer by the change due to the withdrawal or the payment. So that's the 1% we have. So we're going to create this row with the balance on a month-to-month basis. Now in January we have a withdrawal. Remember, this is the cash flows to the company. That means the company borrowed $10,000. And so the bank balance is simply going to be the status after the withdrawal, and the company owes $10,000. Here we are, as you see, this wasn't, the balance was 0 last month, so it's 10,000 at the end of January because it was borrowed at the end of January. That's the assumption made here. Now for February, we're going to calculate the interest, and then we add whatever changes are. In this case, we have a payment of $2,000, payment to the bank. So the interest is going to be 10,000 times 1% or $100. So our balance is going to be 10,100 that we owe. And everything payment, now we're going to have a balance of $8,100 because we've paid back 2,000. So now we're going to do the same here with March. The balance is going to be 8,100 times 1.01. So so $81 extra. And then of course minus 1,500 because it's increased now the borrowing by 1,500. So we have 9,681. We're going to follow this with the same procedure with April and May. So April, we're multiplying the balance of March times 1.01, and now we're going to add the 4,500 because that's cash, well, adding on a negative number, so it's reducing the balance owed. And finally in May, we're going to have 3,330 and 59 cents. So the balance at the end of May is exactly that. Now, if we calculate how much was borrowed and how much was paid back, we have 10,000, 1,500, so it's 11,500 were taken out, and we have 2,000 plus 4,500 plus 2,000, that's 8,500. So we had a net of 3,000. So the $330 and the 59 cents is the interest on the amounts that we have so far, just for your information. Thanks for your attention, and I hope that helped.